Hello, folks. It is Thursday, August the 3rd. It's about 2 o'clock in the afternoon on the East Coast of the United States. In this video, I will be talking about interest rates and the environment that affects interest rates. We'll look at the charts of the U.S. Treasury bills, notes, and bonds. And then I've got some economic charts that we'll look at, which kind of help flesh out the picture of the interest rate environment that we're in currently. And so let's jump right in. Interest rates, recent changes. These are the recent changes. So Japan loosened its yield curve control policy. Basically, it went from a band of 50 basis points around zero for its 10-year yield, went from 50 basis points to 100 basis points, or 1%. So Japan basically has allowed their yield on their 10-year note to raise all the way to 1%, which, again, that's easy monetary policy compared to the rest of the Western world where rates are, 5% or better. Our Treasury, and this was just in the last, I think, 2 days ago, announced their expected bond sales for the third quarter of this year. And I put in parentheses, they didn't say this, but they're having to sell these bonds to cover their deficit spending. Officially we're spending, $1.5 trillion deficit this year. My expectation is that in reality, it's more like $3 or $4 trillion of deficit spending this year, and in particular because they did away with the ceiling on the debt limit. That basically we've got a blank check at this point. Congress has a blank check at this point to spend money. And they're good at it. I guess that's what our tax dollars, that's one of the good things we get for our tax dollars, is that we've hired people who are good at spending our money. That's not a good thing. Obviously, I'm saying that tongue in cheek. Another thing that's happened this week, Fitch has downgraded the U.S. from AAA to AA plus as far as debt. And then the cost of interest on our current U.S. debt is approaching $1 trillion per year. We'll see that chart here in a bit. And of course, as the old debt rolls off, reaches maturity and expires, it has to be replaced with new debt because, again, we're in deficit spending. We're not paying off old debt. We're adding more debt. The cost of the new debt is higher than the cost of the old debt. And so the interest on our debt is increasing. And I would suggest, and we'll see in the chart, that it's increasing exponentially. This just some headlines, and I'll include links to these articles in the description below this video. That's Japan changing their rates. There's Fitch changing the rating. This is the Treasury announcing their estimated bond purchases. This is Market Watch. They're talking about, $1 trillion worth of borrowing in the third quarter. And of course, borrowing, that means selling debt instruments, selling U.S. treasuries. And somebody has to buy these things. And I'll get into that a little bit deeper in this video. But who is that somebody at this point? Who's buying? Who's silly enough to buy U.S. treasuries? I can understand short-term treasuries, a couple of months, maybe a year or 2-year treasuries. But, when you start looking at 10-year, 30-year, who is the silly-ass investor that's putting their money at risk for that period of time to buy U.S. debt? It boggles the mind. This is Wolf Street based on this announcement from the Treasury, it's not just third quarter, it's for the next year. And he's pointing out that they're going to have to increase the size of their monthly auction by 60% going into August of next year. And again, who's buying all of this debt? This article, this is from Simon White, and he makes, in the very end of this article, he makes a couple of points that I thought were interesting. Let's see. Large fiscal deficits are likely to become a feature, not a bug. That means inflation is likely to become embedded. And likely to become, I would disagree with that language. I would say it has already become. We are, and I say this almost in every video, we are now in an environment of sustained high interest rates and high inflation. It's just, that's a factor of our economy at this point. It's unfortunate, but that's where we're at, and I don't see any resolution of that. I don't see it changing. Let's see, yield capping. Oh, and what he's suggesting in this article is that at some point the U.S. Treasury and the U.S. Fed they'll be forced to implement yield curve control. And well, we just looked at, in the last video, we looked at Japan doing yield curve control and not having much luck with it. So, good luck with yield curve control. And if the world didn't already think you were a banana republic with your monetary policy, when you start implementing a formal yield curve control, well, you're definitely, in my opinion, you're definitely into banana republic territory at that point. And there again, yield curve becoming increasingly likely by stealth or otherwise. So he is allowing that yield control doesn't necessarily have to be announced as a formal policy. It could be hidden. So now let's look at the Treasury charts. This is, I just love this chart. This is the yield on the 1-year bill in the monthly time frame. And as I say repeatedly, when this vehicle is moving vertically, bad things are happening in the economy. We can see, there's the global financial crisis, the GFC, big scary plunge in March of 2020. And then this, we don't know exactly, I know what I think it is. And this is global debt collapse. And that's what I'm saying here, is that I believe in hindsight, it will go away. It will widely be acknowledged that this is the collapse of the global debt-based fiat currency system. And that's why this instrument is moving vertically at this point. And there's some labels. Banking collapse started there. That was Evergrande defaulting on their $300 billion. This was the ECB and the Fed actively buying debt in the markets. Let's keep rolling here. So this is the yield on the 1-year bill in the weekly time frame. No real movement this week, but notice that it is above this horizontal resistance level, finding support above that level, and also finding support along the 10-week moving average. This, what was that, 3 weeks ago, that was a big spike higher and then a doji bottom. Now in Japanese candlestick terms, we could look at that as a gravestone doji, which is, typically a topping candle in Japanese terms. I don't believe that is a topping candle. I think that's just an artifact of the interest rate environment that we're currently in. I don't think that will be a top by any means. Yield on the 2-year, this is in the weekly time frame. Again, sideways action at this point. But notice the megaphone pattern, and I went back and refreshed my memory on this megaphone pattern, and it tends to resolve to the upside. And so I had been thinking that this was a bearish pattern, but in statistical terms, that pattern tends to resolve to the upside. MACD in bull mode, energy very elevated. So this chart is supportive of higher interest rates, although right now just moving sideways. Very similar in the 3-year, darn near identical. I've got the wrong, those are moving averages for the daily charts, not the weekly. Let's throw, just for funsies, there's the 10 and the, so same thing we saw in the 2-year, finding support along the 10-week moving average, megaphone pattern. 5-year, we're seeing a little bit of activity this week. We can see we're getting a movement to the upside, pushing into resistance at the upper median line of this shift pitchfork. And then, we're going to have some resistance from those prior highs, so we might expect some resistance in this region. But this chart is definitely suggesting that the 5-year is headed in that direction. MACD in bull mode on a buy signal, energy very elevated, and then these three green candles are suggestive that price wants to go higher. So 10-year, obviously big move this week, and notice as well that we've now broken out above this prior high, poked well above that with a bullish candle. And at this point, I would suggest that that's an impulsive candle because price is so close to the high of that candle at this point. And of course, we're in the weekly time frame, so this candle hasn't closed yet. MACD in bull mode on a buy signal, energy very elevated. So one of the things to notice here is that as we get longer duration in the treasuries, interest rates are moving higher more rapidly, and here again. So here's the 20-year and a big move this week, pushed through this prior high level. Bull mode, buy signal, energy very elevated. And again, this is definitely an impulsive candle, and not only an impulsive candle, we could even refer to it as a wide-ranging candle, which in technical analysis, that's another indication of elevated energy. If you look at this chart as a whole, what you see is a bunch of little small candles with just a few big candles. Like right in there, we've got 3 big green candles. Some of these red candles, like there and there, are fairly large. But notice that's a large candle relative to the rest of the candles in this chart. So we could refer to that as a wide-ranging candle, which again is indicative of elevated energy. So suggestive of higher rates, and again supportive of what I just said, that as we go out in duration, interest rates are moving higher more rapidly. Which reminds me that one of the things that came out in this Treasury announcement is that the bonds that they'll be selling are the longer duration, that they're going to start selling more of the 20 and 30-year duration as opposed to the short term, the 5-year and under. So and so what I think we're seeing in these longer duration charts is that the market is coming around to my viewpoint. How's that for egotistical? That we're in an environment of sustained higher inflation and higher interest rates, and that condition will continue for some extended period into the future. And so the longer duration bonds are pricing in that reality. That would imply that it was a fact, but really it's just my opinion. But obviously, based on these charts, the longer duration bonds are moving higher and moving strongly higher. This is another, again, big move higher this week. Impulsive price bar, MACD in bull mode on a buy signal, energy very elevated. We could probably, again, refer to that as a wide-ranging bar, although, there are other big bars in this chart. So anyway, let's keep rolling. Got some charts now that focus on the U.S. economy. This one in particular, this is the yield curve. In this section of the chart, we're looking at the yield curve. And it's the difference between the 3-month yield, the yield on the 3-month bill, Treasury bill, and the yield on the 10-year note. And so that difference is referred to as the yield curve. And it's believed that when this curve goes negative, as we see in these red areas, that's a indicator that economic recession is coming, will be coming soon. And we can see that. That's these green bars. These are periods of economic recession. And the definition of an economic recession, technical definition, is when, it's the GDP, interest rates and GDP, difference between the two. And so I think I've got that right. Don't hold me to that. I'll have to refresh my memory on that. But anyway, these are periods of economic recession. We can see that the size of this dip into negative territory has some correlation with the duration of the recession period. So this was a little peak down into negative territory. We get a short recession. Of course, that was early to mid 2020, the big scary plunge again. This was a bigger dip into negative territory. We got a wider recession. That was the great financial crisis, GFC, 2007, 2008. This is back 2001. That was after the pop of the dot-com bubble. We got into recession there. Look at the size of the current inversion, this negative yield curve, And so based on if there is a correlation between the size of this negative move and the duration of the upcoming recession, we're in for a doozy. This is suggestive of a deep and prolonged recession. So, I mean, we can hope that that's not the case, but there's certainly a lot of supporting evidence for that. This chart is showing us the federal deficit spending. How much is our government spending, the money that they don't have? And of course, to spend money that they don't have, they have to go sell debt instruments, which of course means they're printing fiat currency. So all of this deficit spending at the end of the day means they're running the printing presses. They're creating money out of thin air, which creates more inflation, etc. I mean, it's just an endless cycle. And unfortunately, I believe we're at the point of exponential growth in that cycle. And there's one truism about exponential growth. It's not sustainable. when you get to the exponential point in a chart, you start, going straight up, and nothing goes straight up. Trees don't grow to the sky, and neither do economies. And so, unfortunately, I think we're at a bad point economically and monetarily. So anyway, deficit spending, we can see here, big scary plunge in 2020, and of course the COVID mess. We had massive deficit spending, more than $3 trillion worth of deficit spending in 2020. We're not spending at that level currently. Based on this chart, it's 1.379 trillion of deficit spending. And this is probably low because remember that we just saw in the third quarter alone, the Treasury is going to sell $1 trillion worth of bonds. And that's suggestive of $1 trillion worth of deficit spending. If they didn't need $1 trillion, they wouldn't sell $1 trillion worth of bonds. And so anyway, it wouldn't be surprising to see this, it's going to go in the other direction, excuse me, that this chart is going to head sharply back to the downside with deeper deficit spending. In this chart, we've got U.S. interest payments. And so how much, this is the cost of carrying the U.S. debt currently. And we can see that cost is approaching $1 trillion per year. And again, exponential growth. I mean, it's a straight line. I mean, almost straight line going upwards. And again, trees don't grow to the sky. And this is what I was saying at the start of the video. Exponential increase in the financing cost as the old debt rolls off, matures and expires, and is replaced with new debt at higher interest rates. Because remember, we were, within the last 2 years, interest rates were essentially zero. And now they're 4% at least, if not 5%. And so we've gone from 0 to 4 or 5%. That's a significant increase in the cost of financing or carrying the U.S. debt. And what is even more scary, I don't know that it's scary, it's just reality, it's unfortunate reality. We're almost at the point where we're borrowing money to pay just the interest on the debt. And of course, that's very definitely, that's end game. That's a spiral into the abyss. When you're borrowing money to pay the interest on the money that you've already borrowed, you're in bad state. It doesn't work for individuals, it doesn't work for companies, and it doesn't work for countries either. I mean, even though they have this thing called the printing press and they can go, we'll go down in the basement, we'll print up a bunch of Benjamins, there is a limit. We don't know what it is, but there is a limit to how much fiat currency you can print before the wheels come off. And we're getting closer and closer to that point. So in this chart, we're seeing this is income to the federal government from tax receipts. So this is individuals and businesses paying taxes to the federal government. Notice this roll-off in the last, in the last year. So there was July of 22, we're in, just started August of 23. And so that's a full year where tax receipts have been declining by, what is that, 400 billion, 0.4 trillion. So pretty substantial drop, 10% in income. And yet, Bidenomics, we're supposed to believe that the economy is strong, not only strong, but growing. I think based on the BLS, the Bureau of Lying Statistics, the economy is supposedly growing at 2.4%. Well, this chart doesn't support that idea. If the economy was actually growing, tax receipts would be increasing. I mean, wouldn't they? Am I missing something here? So in this chart, this is U.S. debt held by foreign and international investors. We've looked at this, I think it was 2 or 3 videos ago when I was talking about interest rates, explaining how the process works. You know, we sell bonds, somebody's got to buy those bonds. And I pointed out in that video, and I'll point it out again, something changed in 2014. You know, prior to that point, China was buying our bonds. Other Western countries were buying our bonds. Latin America was buying our bonds. You know, everybody's buying U.S. government debt. That changed in 2014. And they came in, new buyers stepped into the arena at that point. Belgium, the EU was one of them. Belgium as a country was buying a ridiculous amount of bonds based on their GDP. And I'm emphasizing that again in this chart. Somebody is buying U.S. government debt, and they have to pretend that the somebody is a foreign buyer, that it's not just the Fed printing up fiat currency and buying U.S. debt. You know, obviously that's Banana Republic stuff. And so they have to hide the fact, this is Brian stating his opinion, they have to hide the fact that that's really what's occurring. The Fed is printing fiat currency and buying U.S. government debt. The way they're doing it, so the Cayman Island currently holds $2.2 trillion worth of U.S. debt. Well, their GDP is only $6 billion, and they are currently the 3rd largest foreign holder of U.S. debt. Now, explain to me in the comments below this video, or reach out to me and we'll have a conversation on the phone if you want. Explain to me how a country with a $6 billion GDP accumulates $2.2 trillion worth of U.S. debt. I'd love to hear an explanation, because in my opinion, what's happening here is the U.S. Fed is printing up Benjamins, shipping them off to the Cayman Islands, and the Cayman Island turns around and buys U.S. debt. Same story with Luxembourg. They're the 4th largest foreign holder of U.S. debt at this point. They've got $1.97 trillion worth of treasuries with a GDP of $85 billion. And again, how does a country with $85 billion GDP accumulate almost $2 trillion worth of U.S. debt? It's BS. It just, the numbers don't work. And those numbers come from this chart, which, you know, this treasury.gov, I'm not pulling this stuff out of my tuchus. This is the government telling us, you know, this is where the debt is held. And there's Cayman Islands, number 3, 2.2 trillion. Luxembourg, number 4, 1.9 trillion. So I'm almost at 30 minutes. I'm going to cut it off at this point. So we've had some interesting changes recently, this week, last week, both internationally and within the U.S. I think we got the Bank of England just bumped interest rates another 1/4 point. I'm going to stop here. Hope you enjoyed the video. I'll look forward to talking to you in the next one.